Now we're going to talk through some of these transactions from your textbook. So we have this transaction 1. We've received an investment by the owner. We received $30,000 in cash from Chaz Taylor in exchange for common stock. We look at that source document and we analyze how it affects the accounting equation. It affects an asset account, cash, and an equity account, common stock. We record that journal entry, a debit to cash and a credit to common stock. Then we post that journal entry to our T accounts. We debit cash for $30,000 and we credit common stock for $30,000. After we have recorded all of our accounting transactions for the period, we prepare a trial balance. The trial balance, we list each account and its amount from the ledger in the trial balance. If an account has a 0 balance, we put a 0 or we just leave it out. I would list it and put a 0. Then we add up the total of debit balances and then the total of credit balances. And we want those to equal. So if our accounting equation is correct, we have two truths. Our assets equal liabilities plus equity, and debits equal credits. If our debits do not equal our credits, then we have a mistake that we need to go look for. So that is why one of the reasons why we prepare a trial balance to test and make sure everything's correct before we move on to financial statements. So this is an example of a trial balance from our company in the textbook. So we've listed all of our accounts. You see that we have accounts receivable here, but it has a 0 balance. We list all of our accounts and our debits equal our credits. What happens if our trial balance doesn't balance? Well, we need to find those mistakes if that happens. First, we're going to check our math. Did we add them up correctly? We're going to make sure that we took that information correctly from the ledger. Did we accidentally move a debit or a credit account? We're going to verify that each journal entry is posted correctly. We're going to make sure that each journal entry has equal debits and credits. Then there are some other tricks that we can look for. One of those tricks is if what we're off between our debits and credits, if the amount that we're off can be divided by 9, that is caused by a transposition error. That means at some point we flip two numbers. So instead of recording $63, we accidentally put down $36. Another way to look is to divide it by 2. So if we're off by $4,200, we're going to divide that by 2 and get $2,100. Then we're going to look for any transaction that was for $2,100. What has happened there then is we might have mistakenly recorded a credit instead of a debit or vice versa. So those are two things that we can do to find an error quick before we have to go through each individual journal entry and double check every transaction that we've recorded in the month. After we prepare the trial balance, we can prepare our income statements. So our financial statements. So we have our balance sheet, which is our accounting equation. It's a record of our accounting equation at any given point in time. Assets equal liabilities plus equity. Our income statement is revenues minus expenses. Our statement of retained earnings shows the differences in the equity account throughout the period, and then the statement of cash flow shows how we've used cash during that period of time. We have to prepare them in order. We start with the income statement. We take our revenues minus expenses over that period of time. Now, a period of time in accounting is usually a month, a quarter, or a year. We take that net income or loss, and that appears on the statement of retained earnings. That information then gets transferred to the balance sheet. And then the last statement we prepare is the statement of cash flows. This is an example of our income statement from our company. And when we're in class this week, we'll be preparing journal entries and financial statements. So we have our revenue minus our expenses. They've had net income of $3,395 for the period. That net income then gets moved to the statement of retained earnings. So we can see here where the net income comes to here. So our business just started in the month of December. We had 0 retained earnings at the beginning of December. We add our net income for December, subtract any cash dividends that we paid out, and we get our retained earnings for the end of the month. That amount then goes to our balance sheet. When we are creating our financial statements, we need to find a couple of rules, and when we're preparing our journal entries. So we do not show dollar signs in our journals and ledgers. We don't draw the dollar sign, we don't add the dollar sign. We do use commas to show thousands. Dollar signs do appear in financial statements. They are before the first and last numbers in a column. So anytime we start a column, we put a dollar sign, and then when we end, when we sum, we will put a dollar sign there. When amounts are entered in a journal, ledger, or trial balance, commas are optional, but generally used. Commas are always used in financial statements. We commonly round it to the highest nearest dollar for our financial statements. So we'll record our pennies and cents in the ledger and the journal entries. And for the purpose of this class, you won't have everything will come out roundly to dollars, anything that you're doing for this class. But if we had change and cents, we would, for our financial statements, round to the nearest dollar. This is also common for tax forms for IRS purposes. So that is the end of chapter 2. And in class, we are going to be working on recording transactions and preparing financial statements.